On one side, SUI has shattered its all-time TVL record, forcing whales to scramble and rethink their allocations. On the other, JPMorgan, the banking titan itself, just issued $50 million worth of commercial paper directly on the Solana blockchain. These events aren't isolated. They mark a turning point where retail-driven growth meets institutional validation, and the entire market is watching the fallout. SUI's total value locked, hitting a staggering $2.6 billion, isn't just another headline. It's a loud declaration that this Layer 1 blockchain is finally moving beyond niche status into serious DeFi territory. According to on-chain data showing explosive engagement across decentralized apps, TVL isn't creeping up, it's surging with real economic activity behind it. Just a year ago, SUI's TVL was comfortably under $1 billion, dismissed by some as an experimental chain not ready for the big leagues. Yet here we are, liquidity pouring in, developer interest spiking, and entire protocols like SUI Lend and others driving dynamic lending and yield activity that rivals more mature ecosystems. So what's really going on? Why are investors suddenly taking SUI seriously? For starters, the community is no longer just waiting for hype. It's building real infrastructure, trading real volume, and locking real capital into smart contracts that move money. On-chain DEX volumes are climbing, and data platforms are showing engagement levels that suggest actual usage, not just speculative inflows. You might ask, is this just a short-term craze? It's a fair question. The crypto world has seen explosive metrics before that faded just as fast, but when you couple strong fundamentals with growing stablecoin adoption and cross-protocol activity, it starts to feel more like momentum with substance than a bubble without roots. Honestly, if you thought blockchain was still just a crypto hobbyist's playground, think again. This week, JPMorgan Chase & Co. quietly made history by issuing a $50 million U.S. commercial paper debt instrument on the public Solana blockchain. And yes, that's a big deal. This isn't some internal test or private ledger experiment. It was a real-world issuance arranged for Galaxy Digital Holdings LP and purchased by heavyweights like Coinbase Global and Franklin Templeton. So, let's break that down in everyday terms. Commercial paper is a cornerstone of corporate finance, short-term debt that corporations use to fund operations. Now imagine that traditional settlement infrastructure is being replaced with blockchain rails and stablecoins, USDC. That's exactly what happened here. JPMorgan created an on-chain USCP token, handled delivery versus payment, and even settled everything in Circle's USDC. And here's the kicker. Major institutions aren't just watching, they're participating. Coinbase and Franklin Templeton didn't just sit on the sidelines, they bought this debt. That kind of involvement sends a massive signal to markets and investors alike. With Solana's speed, low fees, and real capital moving on-chain, it sure feels like we're watching the next chapter of financial markets unfold in real time. Honestly, if you had told me a few years ago that decentralized finance and traditional finance would start speaking the same language, I'd have raised an eyebrow. Yet here we are, where networks like SUI are surging in real economic activity just as Wall Street heavyweights are dipping their toes and capital into on-chain systems. Over the past 12 months, SUI's total value locked has ballooned into the billions, demonstrating real liquidity commitment and ecosystem adoption long past its early experimental phase. Data aggregators report that its TVL has climbed dramatically, driven by deep stablecoin flows, DEX activity, and a growing roster of DeFi protocols. At the same time, JPMorgan, one of the world's largest financial institutions, made a landmark move by issuing a $50 million tokenized commercial paper on the public Solana blockchain. This wasn't a private test or internal ledger, it was real debt settled in USDC and bought by mainstream firms like Coinbase and Franklin Templeton. So what's happening here? Is this just coincidence or a genuine convergence of worlds? When DeFi's grassroots liquidity momentum meets TradFi's institutional firepower, you start to see a new financial paradigm emerge. Liquidity, user adoption, and institutional capital aren't living in separate universes anymore. They're converging, and it could reshape which blockchains come out on top. When you hear the term total value locked, TVL, think of it as more than just a number. It's a measure of trust, utility, and real money being committed to a blockchain ecosystem. And right now, SUI is making headlines for surpassing $2.6 billion in TVL, a number that signals something much bigger than hype. This isn't about flash-in-the-pan attention. Thousands of users are actively locking their funds into lending protocols, staking contracts, and yield farming platforms on the SUI network. Why does that matter? Because sustained growth over months rather than a single viral cycle shows that the ecosystem has structural maturity. Analysts at Messari and CoinGecko highlight that consistent inflows across multiple protocols suggest real adoption, not speculative pump-and-dump behavior.
SUI is no longer a testnet curiosity. It's transforming into an economic engine capable of supporting real financial activity. As DeFi dashboards show, liquidity across platforms like SuiLend, Momentum, and Navi continues to climb, validating both user confidence and developer engagement. At first glance, $50 million might not sound like a blockbuster in traditional finance, but in the context of blockchain, JPMorgan's recent Solana-based commercial paper issuance is seismic. Commercial paper has long been the backbone of global liquidity markets, allowing corporations to meet short-term funding needs efficiently. Now, for the first time, one of the world's largest banks has issued it directly on a public blockchain backed by USDC stablecoins. Think about that for a second. High-value, regulated financial instruments running on a blockchain that's open, fast, and low-cost. This isn't some theoretical experiment. It's a real transaction, demonstrating that public chains can handle institutional-scale finance. The benefits are tangible. Settlement happens almost instantly, intermediaries that once slowed processes are removed, and operational costs shrink dramatically. It's a clear blueprint for how traditional finance can adopt blockchain without compromising compliance. Analysts at CoinDesk note that if this approach scales across multiple banks, the influx of capital could surpass anything DeFi has seen, potentially bringing billions or even trillions onto public blockchains.
Think about SUI's total value locked growth by 160% year over year. That's not just a stat for the charts, it's the kind of story crypto investors dream about. To put it in perspective, if you had invested $1,000 in SUI's ecosystem a year ago, your hypothetical stake would now reflect around $2,600 just from protocol-level growth alone. But this isn't about luck or short-term hype. Analysts from Masari and CoinGecko point out that SUI's growth is driven by consistent adoption across lending, staking, and yield farming platforms, showing structural maturity rather than speculative frenzy. What does this mean for the broader market? Suddenly, SUI is no longer the maybe small chain in the corner. Influencers, institutional observers, and even developers on Ethereum and Arbitrum are paying attention. Protocol launches, liquidity migrations, and developer tools are accelerating. SUI is actively shaping user behavior and ecosystem dynamics. Ask yourself, could a chain that was once dismissed now be setting the pace for Layer 1 competition? With adoption surging and TVL climbing faster than many expected, SUI isn't just a player anymore. It's a contender, capable of influencing which protocols thrive and which chains struggle to keep up. The question now isn't if SUI matters, it's how far it can go before reshaping the DeFi landscape entirely. In contrast, let's talk about JPMorgan's Solana-based commercial paper issuance, because it's stirring more than just curiosity, it's dividing opinion on Wall Street. Institutional analysts are split. Some are calling it a blockchain-based capital markets revolution, a glimpse into a future where high-value debt and corporate finance run seamlessly on public chains. Others, however, urge caution. They argue that regulatory frameworks are still evolving, and moving trillions of dollars on-chain might be premature without clearer compliance guidance. On trading floors, sentiment ranges from excitement to skepticism. Some brokers are whispering, is this the future of finance? While others worry regulators may slow or even halt adoption if safeguards aren't in place. But here's the key takeaway. Nobody is ignoring it anymore. The fact that a bank of JPMorgan's scale moved real capital on a public blockchain has forced both traditional finance and crypto markets to pay attention. Analysts at Bloomberg Intelligence note that this move could set a precedent for other institutions, potentially accelerating the tokenization of corporate debt and redefining liquidity in capital markets. If you want to truly understand why SUI is gaining so much momentum, you have to dive into its ecosystem. Take SuiLend, for example. Its lending markets are rapidly expanding, attracting users who are looking for efficient borrowing conditions and competitive interest rates. Then there's Momentum, SUI's yield farming platform, which is onboarding waves of liquidity as APYs stabilize, giving users confidence that their returns are reliable and not just a fleeting hype cycle. And let's not forget Navi, SUI's staking solution. By offering consistent, predictable returns, it's steadily building user trust, the kind of trust that is crucial for long-term ecosystem growth. What's fascinating is how these platforms interact. They create a flywheel effect. More users generate more liquidity attracts additional protocols, and more protocols encourage even more users. This self-reinforcing loop is exactly why SUI's total value locked recently surged past $2.6 billion. Think about this. Institutional players demand reliability, speed, and predictability. Ethereum, despite ongoing upgrades, still struggles with fluctuating gas fees and network congestion, friction that simply isn't acceptable when moving millions of dollars in regulated debt.
Solana, by contrast, provides deterministic settlement times and minimal transaction costs, which are critical for corporate finance. This decision signals something bigger. When a banking giant like JPMorgan opts for a high-performance chain over a legacy network, it hints at a potential reshuffling of blockchain hierarchies. Could we see high-stakes financial instruments increasingly favoring speed, scalability, and efficiency rather than brand dominance or historical market share? With Solana proving it can handle real, regulated, high-value transactions, the rules of institutional adoption may be changing fast. The game isn't just about decentralization anymore. It's about performance, reliability, and who can move capital fastest. Every meteoric rise in crypto naturally sparks questions, and Sui's recent liquidity surge is no exception. Analysts are asking, are these inflows sustainable, or is a correction lurking just around the corner? It's hard not to draw comparisons with early days of Solana and Avalanche, which also experienced explosive growth before skeptics doubted their staying power. Yet both chains matured into robust ecosystems, attracting developers, protocols, and substantial liquidity over time. Could Sui follow the same trajectory? If steady adoption continues across lending, staking, and yield farming platforms, Sui could climb into the upper echelons of DeFi chains, reshaping where users and capital congregate. But let's be real, momentum can be fragile. If liquidity inflows stall or user engagement dips, the climb could slow dramatically, leaving Sui vulnerable to competition from Ethereum, Arbitrum, or other Layer 1 networks. TVL surpassing $2.6 billion and developer interest growing, Sui is positioning itself as more than just a speculative play. But only time, user adoption, and liquidity flows will determine whether it can sustain this momentum and truly rival the top Layer 1s. As more institutions, like JPMorgan, dive into on-chain finance, all eyes are on regulators. Tokenized debt, like the $50 million commercial paper JPMorgan issued on Solana, isn't just a tech experiment. It raises real legal questions around custody, transparency, transferability, and jurisdiction. Some critics warn that without clear regulatory frameworks, tokenized instruments could hit sudden roadblocks, slowing adoption or creating compliance headaches. Could a minor legal misstep stall what might otherwise become a trillion-dollar shift in market capitals? On the flip side, supporters argue that blockchain's transparency and traceability actually enhance safety, making tokenized debt more auditable and less prone to errors than traditional settlement methods. Analysts at CoinDesk note that on-chain record-keeping could fundamentally improve market integrity and reduce systemic risk. So the tension is real. Will regulators accelerate innovation, giving institutions confidence to scale tokenized products globally, or will they impose restrictions that slow progress? The decisions made in the coming months will shape the trajectory of institutional crypto adoption for years to come. Even with its explosive growth, Sui still lags behind giants like Ethereum and Arbitrum in total transaction volume, but the gap is narrowing fast. More and more users tired of high fees and network congestion on larger chains are quietly exploring alternatives, and Sui is emerging as a prime candidate. What makes Sui appealing is its combination of speed, low fees, and growing protocol ecosystem. Developers are refining the network architecture while rolling out new projects across lending, staking, and yield farming, giving the chain an increasingly magnetic pull. It's not just about users, though. Attracting developers is crucial for long-term dominance. If Sui continues to lower friction, provide better onboarding tools, and offer reliable incentives, it could start pulling talent away from more established Layer 1s. Analysts at Messari and CoinGecko point out that such momentum, if sustained, has the potential to reshape DeFi hierarchies over the next 12 to 18 months. So the question becomes, can Sui maintain this momentum long enough to challenge entrenched Layer 1 dominance and capture the next wave of developers? With TVL surging past $2.6 billion and user engagement rising steadily, it's clear that Sui isn't just a fledgling chain anymore, it's a serious contender, and the next year could define whether it becomes a top-tier DeFi powerhouse. Here's the thing. When a major bank goes on-chain with real money, others usually take notice and often follow quickly. JPMorgan's $50 million commercial paper issuance on Solana isn't just a headline, it's a potential blueprint for how institutional finance could operate in a tokenized world. If JPMorgan's Solana experiment proves successful, it's reasonable to expect Citi, HSBC, and Deutsche Bank to explore similar tokenized offerings. And we're not talking pocket change. This could gradually move billions, even trillions of dollars of assets onto public blockchains. Why does this matter? Because once institutional adoption reaches a tipping point, the intersection of DeFi and traditional finance could accelerate far faster than most people anticipate. Tokenized debt, settlement, and other on-chain instruments could streamline operations, reduce costs, and make liquidity far more efficient. Analysts at CoinDesk and Bloomberg Intelligence suggest that such a shift could redefine how capital flows globally, blurring the lines between centralized and decentralized financial systems. Now let's imagine two powerful trajectories converging over the next 12 months. On one hand, you have Sui's explosive ecosystem growth. Its total value locked has surged past $2.6 billion, fueled by lending, staking, and yield farming protocols that attract thousands of users daily. On the other hand, traditional banking is slowly but decisively migrating onto blockchains. JPMorgan's $50 million tokenized commercial paper on Solana, settled in USDC, isn't a one-off. It signals that institutional capital is exploring public chains as viable infrastructure. Now picture these two forces intersecting. Grassroots liquidity and DeFi adoption continue to scale on networks like Sui, while institutional players start moving trillions in tokenized debt, settlements, and other financial instruments. What happens then? These dynamics could clash, amplify, or reshape each other. Decentralized communities may find themselves competing with regulated capital flows, or they may benefit from the increased liquidity and infrastructure that institutions bring. Analysts at CoinDesk and Bloomberg Intelligence suggest that such a convergence could create a hybrid financial ecosystem, blending DeFi innovation with the stability and scale of TradFi. So ask yourself, are we on the cusp of a new financial era where power shifts unpredictably and the lines between decentralized and institutional finance blur? The next 12 months could answer that question and change finance forever. Are we witnessing the early stages of decentralized upstarts like Sui rising to challenge giants, or the moment traditional institutions begin asserting control over blockchain's future? Will Sui's momentum elevate it into a top DeFi contender, or will institutional on-chain adoption shift the center of gravity elsewhere? The battle between fast-moving DeFi ecosystems and Wall Street's billion-dollar engines is just beginning, and your predictions might age into a prophecy. Click the card above to watch more interesting videos. This is Blockchain Money.